On March the 12th, 2023, in New York City, a routine software maintenance procedure was underway at a major banking institution, National Finance Solutions, commonly known as NFS. This bank, one of the largest retail banks in the United States, had long relied on a decades-old transaction processing system to handle its daily operations. This legacy system, while essential for processing millions of transactions every day, had not been updated for several critical software versions due to a combination of internal inertia, cost-cutting measures, and a growing reliance on outdated infrastructure. On that day, an internal team tasked with monitoring the bank's digital ecosystem discovered a minor software bug within the transaction processing system. The bug was linked to an outdated library that had been flagged by cybersecurity experts months prior. However, due to misconfigurations and insufficient prioritization of cybersecurity protocol updates, the necessary upgrade processes had not been implemented. The organization had mistakenly assumed that, as long as the system remained operational, immediate updates could be deferred. This oversight, compounded by a lack of dedicated personnel to conduct thorough security assessments, set the stage for an imminent crisis. As the internal team investigated the bug, they uncovered a significant technical failure related to user permissions. A misconfiguration allowed unverified external access to certain system functions, inadvertently exposing sensitive areas of the software to potential exploitation. The system's internal logging failed to capture crucial access attempts, which later contributed to a lack of visibility regarding unauthorized activities. This gap meant that any anomalies occurring within the system could go undetected, paving the way for more serious issues to proliferate unnoticed. By the following day, the measurable impacts of this oversight became apparent. More than 1.5 million customers reported disrupted service, with transactions either failing to process or taking exceptionally long to complete. As a result, NFS tracked an estimated loss of $3 million in transaction-related revenues within just 48 hours. Users flooded into the bank's customer service channels, producing a backlog that left many pressing financial obligations unmet. The fallout from these initial disruptions spread to other banks, particularly those dependent on NFS's systems for interbank transactions, leading to ripple effects across the industry. Internally, confusion reigned at NFS. Employees exchanged a series of hurried emails discussing a _quote _0_ without grasping the underlying cause, and the incident response team convened an urgent meeting in an attempt to pinpoint the source of the failures. In the incident channel, initial assumptions circulated that the service interruptions were due to high transaction volume rather than internal flaws or external threats. As IT personnel scrambled to issue partial fixes, they focused on tweaking system configurations and isolating segments of the software for manual inspection, hoping to contain the immediate symptoms rather than addressing the root cause. Externally, alarm bells began to ring. Monitoring alerts were triggered, reflecting a sharp increase in transaction errors that were broadcasted through multiple banking networks, garnering attention from industry observers. Users took to social media, voicing their frustrations and drawing media attention. Several minor media outlets covered the growing disruption, labeling it a glitch, while raising questions about the reliability of banking technologies amidst increasing concerns over cybersecurity. As hours turned into days, the urgency of the situation prompted NFS executives to initiate a series of escalation meetings, but the focus remained myopic. Instead of reevaluating their legacy software strategy, discussions centered around mitigating the effects of the service disruptions. This tight focus on immediate fixes began to spark internal divisions over how to allocate resources effectively for both short-term solutions and long-term security upgrades. As the situation escalated, external pressure mounted. Other financial institutions began to issue statements, warning customers about potential issues with transactions linked to NFS. The banking sector was on high alert, with interbank communication growing tense. Collaboration efforts led to the formation of a task force among banks that relied on NFS's systems. However, this task force struggled with its own set of communication hurdles, leading to a delay in shared intelligence on the ongoing crisis. By March 15th, the third day of disruptions, a security notice was issued internally at NFS, urging employees to adhere to strict protocols as the incident response team worked around the clock. Meanwhile, external user reports continued to pour in. There was a growing sense of mistrust among customers, with many expressing concerns over the safety of their financial asset integrity in light of ongoing service failures. Customers began to withdraw funds, driven by fears of potential bank insolvency or inability to access their accounts. As the chaos unfolded, the reality of the situation led to increased scrutiny from regulatory bodies. A preliminary investigation was announced, and questions regarding the bank's cybersecurity practices emerged. NFAs faced not just operational challenges from the software bug, but the realization that their cybersecurity posture, rooted in a false sense of security given by their decades-old systems, had become untenable. The challenge ahead loomed large. Time was of the essence, and despite the immediate work underway, the inconsistencies, communication breaches, and lack of overall risk assessment threatened to expose far deeper vulnerabilities within the banking infrastructure. Multiple input channels from stakeholders began feeding information into response efforts, but the underlying risk of further failures remained unmitigated. In the ensuing days, the situation was far from resolved. As the investigation began to delve deeper into the factors leading to the bug's exploitation, pressures mounted within the banking community, and external agencies sought answers. The stage was set for a crisis that would not only affect one banking institution, but shake the entire foundation of confidence in digital banking. On March 16th, 2023, the incident response escalated to a critical level when NFS's failure to remedy the underlying vulnerabilities led to a massive increase in transaction errors across multiple banks. By this time, law enforcement agencies stepped in, suspecting a coordinated cyber attack. The FBI was notified, and a formal investigation was launched to assess the extent of the breaches. The urgency prompted NFAs to allocate resources towards an internal audit, which aimed to uncover the systemic flaws that had allowed such an exploit. As the internal audit revealed the extent of the outdated technology, the situation further deteriorated. By March 17th, NFS began to see widespread outages as banks across the country suspended services reliant on its platform. Reports showed that over 40 million users across 200 financial institutions experienced transaction failures, limited access to online banking, and in some cases, duplicate transactions draining accounts. On March 18th, with news outlets ramping up coverage of the crisis, various state regulatory agencies initiated investigations. Legal notices were drafted, indicating potential sanctions and repercussions stemming from failure to adhere to cybersecurity standards. Citing consumer protection regulations, a number of state attorneys general filed preliminary inquiries about the bank's practices. Social media campaigns erupted, with hashtags urging accountability trending nationally, exacerbating consumer anxiety over the safety of their funds. On March 19th, the NFS CEO held a press conference that did little to quell public discontent. Despite acknowledging the crisis, the emphasis on ongoing investigations and efforts to rectify a temporary service disruption seemed misaligned with the realities customers were experiencing. A wave of service criticism ensued from both consumers and industry experts, suggesting a cover-up of deeper systemic issues. The public's lack of trust in NFS's capacity to safeguard their financial well-being became apparent, leading to further withdrawals and a significant loss of customer accounts. By March the 22nd, as investigations became more robust, leaks of internal communications revealed a troubling pattern. Warnings about the inadequacies of the aging transaction system had been repeatedly ignored for over a year. Key decision-makers had chosen to prioritize short-term financial savings over long-term investment in technology upgrades, a choice that now had devastating consequences. Journalists analyzing these leaks began publishing exposés detailing ignored internal memos and their alarming content, which highlighted previous red flags regarding capacity and vulnerability to external threats. By the end of March, NFS's situation worsened considerably, leading to a liquidity crisis exacerbated by customer panic. The stock prices of all major banks reliant on NFS dropped sharply, leading to an estimated $2 billion in losses within a week. On April 1st, NFS was officially deemed insolvent, unable to stabilize its offerings without a government bailout or merger opportunity. The interconnected nature of the banking ecosystem further fueled the urgency for wider-ranging responses as other financial institutions experienced cascading failures. In light of the escalating crisis, the Federal Reserve initiated emergency measures to stabilize the banking sector. On April 3rd, an unprecedented coordinated effort was announced, enabling emergency funding for banks affected by the disruptions linked to NFS. Concurrently, NFS faced lawsuits from both consumers and financial institutions, leading to class action filings reported in numerous federal courts. In a further attempt to clamp down on the fallout, the Department of Justice issued subpoenas for all relevant communications within NFS as part of a comprehensive investigation that included fraud charges against senior executives. By late April, multiple arrests were made, targeting key individuals who failed to address warnings about the aging technology despite clear indications of an imminent crisis. The implications for NFS became irreversible. By May 2023, the funding from emergency measures proved ineffective without profound changes in operational management and technology infrastructure. An agreement was reached to dissolve the company entirely after negotiations led to a merger with a more resilient, tech-savvy banking organization. On May 15, 2023, NFS was officially shuttered, marking one of the significant collapses in American banking history. Systemic revisions were mandated across collaborating institutions to fortify operational integrity and prevent a recurrence of such failures. The widespread attention drew in policymakers to implement stricter regulatory measures within the banking technology sector. The final status, as of June 2023, remains that NFS no longer exists as a banking entity. A full review of its practices and the events leading to its collapse is ongoing, with a commitment to enhancing systemic cybersecurity protocols across all platforms in the financial industry. Reforms initiated post-collapse have triggered a broader conversation about technological obsolescence and the maintenance protocols in critical financial systems to safeguard against future risks.